Precious metals extending a meltdown sparked on Friday. Investors anticipating U.S. President Donald Trump's nominee to the Federal Reserve chair, that's Kevin Warsh, as unlikely to cut rates as much as the U.S. leader might want. Given Mr. Warsh's strong stance on inflation, the collapse in prices also taking place after top commodity exchange CME Group raised margins required on precious metals futures trading. The change is wiping out most of the gains gold has made in its record-breaking rally this year. The bullion tanking as much as 10% today after its biggest plunge in decades on Friday. Silver as well losing much of its shine from an all-time high last week, diving as much as 16%. And for more analysis, Michael Brown is senior research strategist at Pepperstone. He joins us live from London. Mr. Brown, most nights when we read gold prices reaching another record high, we cite the reason of geopolitical concerns. Well, this has not gone away, surely.
Well, good evening from London. You're absolutely right. It hasn't gone away at all. There is still plenty of geopolitical risk in the world. And in fact, all of the factors that we often cite as being behind the meteoric rise in precious metals are still in place, whether that be buying from central banks, whether that be investors looking to protect themselves against some of that geopolitical risk, or whether it be worries about the ever-increasing amount of debt that governments are taking on across the globe. I think what we've seen very simply is a market that has run far too fast to the upside, such that actually it became detached from a lot of those fundamentals, which is then why we've seen this pretty brutal positioning unwind over the last 2 or 2.5 trading sessions, which has basically wiped out all of the gains that we've made on a year-to-date basis. I think it's much more driven by technical factors as opposed to any distinct or significant changes in the underlying backdrop.
Well, in other words, momentum and volatility can work both ways. If we are back to reality, where is that reality in terms of prices?
Well, you're absolutely right. There's a sort of old market adage, which is that assets take the stairs up and the elevator down. And I think that's really what we've seen with both gold and silver. The unwind of some of those momentum positions has been pretty brutal, as we said. And of course, as selling pressure has come in, that's resulted in even more selling pressure. And it created something of a vicious cycle, which we've even seen playing out today. The market has started to stabilize a little bit, and you've seen buyers coming in around 4,700 or 4,500 in gold and around $75, $80 an ounce in silver. I think what we really need to see now is a period of consolidation, a period where the market moves sideways for a little while and potentially becomes a little bit more boring, which would imply that a lot of the speculative frenzy that drove prices higher has actually come out of the market, and we're starting to recouple with those fundamentals once more. So that's really what I'm looking for this week, is actually a period of metals doing nothing much at all.
All right. We talk about metals. We should not be conflating gold, silver, and copper. In a way, it's a suggestion of how far they have become detached. The prices have been detached from fundamental realities. Gold, very different from silver, usually much more volatile silver, and copper, an indication of industrial activity. The fact that we're lumping them all together, big mistake, no?
I wouldn't say it's a mistake, actually. I would say it's an illustration of how the market is being driven by positioning and as opposed to any fundamentals. As you say, gold is usually that store of value, the safest of safe assets. Silver a little bit more volatile, and copper moves in line with shifts in the underlying economy. The fact that the correlation between the three has effectively gone to 1 and they all rallied together and are now all falling together implies to me that actually the market was detached from its fundamentals, and arguably remains so, given that the correlation between the three is so tight. So again, perhaps another sign to look for that the move could be coming to an end in terms of this pullback would be those divergences starting to open up between the three, which would imply that we're getting back to those fundamentals being more of a driver.
A final question, and we're going slightly sideways because we began with this. The sell-off triggered, at least on the surface, by Mr. Trump nominating Kevin Warsh as his pick for Fed chair. The idea that central bank independence might be maintained under Mr. Warsh. Mr. Trump, mercurial, to say the least. So central bank independence, levels of government debt, geopolitical tensions, and very strong still retail demand for gold. Where are we headed on the prices, at least of gold and silver?
Yeah, I mean, all of that continues to ring very, very true indeed. I think, we're naturally expecting Trump's pick for Fed chair to adopt a more dovish approach. There sadly seems to be no sign that geopolitical risk is going to be dialed down anytime soon. And borrowing is on an unsustainable path, as we know. So I think the longer run path for gold and for silver and for precious metals more broadly does continue to lead to the upside, given that, and also the hard facts that, frankly, we are using more silver, more platinum, more palladium than we pull out of the ground every year. The question is, at what point does the market bottom out? We are trying to put in a little bit more of a bottom today. We'll see whether that proves durable or not. But overall, I think the bull case remains a robust one. And I'd be relatively confident saying that metals prices will probably end the year higher than where they currently trade.
Oh, thanks. Michael Brown, Senior Research Strategist at Pepperstone, speaking to us there from London.